Hello and welcome to AS23 again. We have completed question number 9. Now let us come to question number 10. X Limited has invested to the extent of 25% in Y & Company during the end of the financial year. For the purpose of reporting, X Limited, the investor company, values its investment in the associate. It finds that its share of losses of the associate exceeds the amount at which investment is carried. So what will be the answer of that? Investment will be carried at nil amount, because if the share of loss, investment is carried at nil amount, because if the share of loss is more than the carrying amount, investment will be shown at nil amount. Further, in the current year, the associate reports loss. Should X Limited recognize the loss for the current year? Should X Limited recognize the loss for the current year? The answer is investment will be shown at nil value. It should not recognize further loss. But there is one exception which we have studied in the earlier question. Additional losses will be provided only if the investor has incurred an obligation or has given guarantee on behalf of associate. This question was taken from RTP May 2013, and the answer of all such questions where the share in loss exceeds the carrying amount, you will write two things. First, you will write investment will be carried at nil value, but then you will also write a note that additional loss can be provided. That note was given in question number 4 and question number 5. So same note you will mention here also. So read this answer. All of you please read the answer. AS23 speaks about the recognition of losses. As per AS23, if the carrying amount of the investment exceeds or equals the investor's share of loss, investor stop recognizing further losses and carries the investment at nil value. Therefore, X Limited need not recognize its share of loss for the current year and shall carry the investment at nil value for the purpose of CFS. However, in the case of separate financial statement, permanent diminution in the value, if any, should be adjusted from the carrying amount. That is given in, write down AS13. This line is as per AS13. If there is a permanent decline in the value of investment, you will have to make a provision for diminution in the value of investment as per AS13 in the separate financial statement. Now we'll go to question number 11. A very different question. Source, write down reference book. Source is a reference book. Your study material does not have enough question on AS23, so I have to find additional questions for your understanding and practice. So here we have question number 11. A Limited acquired 20,000 equity share in B Limited on 1/4/2000. 20,000 shares acquired. 20,000 shares acquired. What is the cost of acquisition? 3,20,000, out of which 1 lakh shares, out of 1 lakh equity shares outstanding. So percentage holding will be 20,000 share, divide by 1 lakh share is equal to 20%. So that is the interpretation of first line. 20% shares were acquired on 1/4/2000 for rupees 3,20,000, and the problem says the credit balance of P&L account on that date was 3 lakh. In the associate book, P&L account was 3 lakh rupees. Profit for the year 2000-2001, that means I will say the profit for year ended 31st March 2001, profit of associate, profit earned by associate is 2 lakh. Then for the year ended 31st March 2002, the profit of the associate is rupees 2,50,000, and for year ended 31st March 2003, the profit earned by the associate is 3 lakh. Is it right? So up to this is clear from the timeline. Now it says an important line, B Limited declared 10% dividend each year. B Limited declared 10% dividend each year. What is the policy of associate to pay 10% dividend? How much dividend they are paying every year? You can see 1 lakh share capital into 10. 1 lakh into 10. 10 lakh into 10%. 1 lakh rupees dividend is paid in July in respect of immediately previous year, which means July 2000, dividend paid 1 lakh. Dividend paid 1 lakh. Then again July 2001, dividend paid by associate 1 lakh. Then July 2002, dividend paid by associate 1 lakh. Is this right? Which also means dividend received by A Limited is 20% of 1 lakh. Dividend received every July 20,000. Dividend received by A Limited 20,000. Dividend received 20,000. I hope this is understandable. But this dividend relates to previous year. This dividend relates to previous year. Now the student should understand the shares were acquired on 1/4/2000. Dividend received in July 2000 for the year ended 31st March 2000. So this first dividend is dividend out of pre-acquisition profit. The first dividend is dividend out of pre-acquisition profit because it is related to 31st March 2000, but the shares were acquired on 1st April. This dividend 20,000 will be deducted from the carrying amount of investment, which we have done in question number 9 also, and this dividend out of pre-acquisition profit is deducted from carrying amount of investment is given in AS 13. It is treated as a recovery of cost because you paid 3,20,000 and immediately you got 20,000 rupees dividend. So out of 320, 20,000 you have recovered back. So your cost of acquisition will reduce. Cost of acquisition will reduce by 20,000. Okay. So cost of acquisition 3,20,000. We are going to reduce by 20,000, and therefore the net cost of acquisition for all further accounting will be rupees 3 lakh. Next point, A Limited is preparing consolidated balance sheet for the first time in 2002-2003. So that is interesting. it is preparing consolidated financial statement for the first time, standard is followed for the first time in 2002-2003. This is the first year the company wants to apply AS 23. Now there is a provision in accounting standard 23. Earlier you were not applying AS 23. During this period from 1st April 2000 to 31st March 2002, you were not following AS 23, but now you will start following AS 23 from, let us say, 1/4/2002. So what you have to do, you have to calculate the carrying amount of investment. You have to calculate the carrying amount of investment in associate in CFS had you followed AS 23 from the beginning. So retrospectively we'll have to find out, had I followed AS 23 from the beginning, how much will be the carrying amount? If I would have applied AS 23 right from the date of acquisition till 1st April 2002, what will be the carrying amount in the books on 1/4/2002? Find out that, compare with existing book value, and the difference will be adjusted by debiting investment account and crediting reserve. For the first time when you apply AS 23, the difference between the existing carrying amount and the carrying amount that would have been determined as per AS 23 would be adjusted in reserve, and after that whatever adjustment you have to do, you will have to do as required by AS 23, usually in consolidated profit and loss account. So I have to make two working note first. First, I have to adjust the cost of acquisition because there is a dividend out of pre-acquisition profit. Second, I have to find out, had I followed the standard right from the beginning till the date when this standard becomes applicable for the first time, what would have been the carrying amount, and then subsequent treatment of that. So I hope you are ready. Let us first understand this note. On the first occasion when investment in associate is accounted for in CFS, in accordance with this statement, the carrying amount of the investment in associate should be brought to the amount that would have resulted had the equity method of accounting been followed as per this statement since the acquisition of the associate. So you have to apply retrospective effect. If you are not following AS 23 earlier, now you are following AS 23 from a particular date, then compute the carrying amount of investment as if you had followed AS 23 from the date the acquisition in associate was made. Okay, and after finding the carrying amount, the corresponding adjustment would be made, because one effect will be in investment in associate debit, but where is the credit effect? For the first time application of AS 23, the adjustment will be made in retained earning in consolidated financial statement. Please note, whatever we are discussing in this chapter is applicable in consolidated financial statement. In separate financial statement, AS 13 will be followed. So my first task is to revise the cost of investment. Cost of investment, first line of the question, 3,20,000. Out of that, we need to adjust pre-acquisition dividend received in July 2000. In July 2000, we have received 1 lakh into 20%, but that is as per AS 13. This is as per accounting standard 13, and therefore the net cost of acquisition is 3 lakh. So my book value will be 3 lakh and I will continue to show this amount in the books because earlier I was not following AS 23. Now we will see, had I followed AS 23 from the beginning, what will be the carrying amount at the end of 31st March 2002. So we start with 3 lakh, 20,000 minus dividend 20,000, 2 lakh. This is July adjusted in investment. We could have started writing the answer from 3 lakh also. Then in the next year 2000-2001, the profit earned is 2 lakh rupees. You have to write the calculation. Profit earned by associate is 2 lakh. Share of investor 40,000. So balance is 3,40,000. Now again in July 2001, dividend was received as per AS 23. Now this adjustment is as per AS 23. This adjustment was done as per AS 13 because that is the dividend out of pre-acquisition profit. Here we are reducing the carrying amount of investment because the associate net asset has reduced. So that is 20,000. My balance will become 3 lakh 20,000 in July. And again for the year ended 31st March 2002, the associate has made a profit of 2,50,000 into 20%. This is 50,000. And therefore, investment balance on 31st March 23 as per AS 23 would have been 3,70,000. But what is the existing carrying amount? 3 lakh, because they are not following AS 23 till the end of 31st March 2002. So 3 lakh is the existing carrying amount. I need to increase it to 3,70,000. So I will have to increase carrying amount of investment by 70,000 and a corresponding effect will be given in retained earning. So we have written the journal entry also for understanding. This entry we will pass on 1/4/2002. You can write the date please. 1/4/2002. On 1/4/2002, investment in B Limited account debit 70,000 to retained earnings 70,000. They have given the calculation 40,000 plus 50,000 minus 30, or you can write in bracket, which is easy for you to understand, 3,70,000 minus 3 lakh. Your book value before was 3 lakh. It should have been 3,70,000 as per AS 23. So therefore the adjustment of 70,000 will be done. So this is called adjusting the balance in investment account on first time application of AS 23. Okay. You will not find this type of question in study material or other books also. This year, that is 31st March 2003, this associate has made a profit of 3 lakh. So please write the calculation. 3 lakh into 20%. 3 lakh into 20%. The associate made a profit of 3 lakh. Our share is 20%. So 60,000. So investment in B Limited account debit, investment will increase to income from associate in bracket consolidated P&L account. The second effect will go to consolidated P&L account, and they have paid you dividend also. Dividend was paid in July 2002. Right here, July 2002, 20,000, bank account debit 20,000 to investment in B Limited 20,000. How this has come? Dividend paid 1 lakh, by associate our share is 20%, being dividend received deducted from carrying amount of investment in consolidated financial statement, being dividend received deducted from carrying amount of investment in consolidated financial statement. So this is the answer of this question. Now we'll take some important questions. Number 12, taken from RTP November 12. The students are requested to mark it as very important question. Very important question. Please mark it. I am sure you are going to mark it as an important question. So let us come to 12. Consolidated balance sheet of Mohan Limited Group and its associates Sohan Limited on 31st March 10 before adjustment for equity method. Underline, this is before adjustment for equity method are given below. One second. Yes. Now it says rupees in 1000, equity share capital, capital reserve, profit and loss account, minority interest, sundry liabilities, and there is a proposed dividend also. Tick mark. Proposed dividend is a part of profit. Proposed dividend is a part of profit because it was created by debiting profit and loss account and it has not yet paid the dividend. Sohan Limited is associate. Now asset side is sundry asset and investment in Sohan. Investment in Sohan Limited 150, that is cost of acquisition. This is cost of acquisition 150. Now we'll come to next line. Mohan Limited acquired 30% ordinary share of Sohan Limited on 1/4/2008. This date is 1/4/8 for rupees 1,50,000. The balance of A Limited profit and loss on that date, balance of A Limited profit and loss, it should not be A, you make it Sohan. The balance in the P&L account of Sohan Limited was 1,80,000. Mohan Limited is preparing consolidated financial statement of the group on 31st March 10 as per equity method. The method of accounting in AS23 is called equity method. You are required to compute goodwill, if any, arising on acquisition of Sohan Limited share. Show how Mohan will reflect the investment in consolidated financial statement. So we'll have to prepare first working note on goodwill or capital reserve. Which is very easy. Cost of acquisition you will find in the balance sheet 150. Cost of acquisition is 150. Then we have to compute share in net asset of associate on date of acquisition. Share in net asset of associate on date of acquisition. So for that I have to add two things. I have to add this share capital 300 plus the profit on that date, profit and loss account balance on the date of acquisition 1,80,000. So 300 share capital, 180 P&L account on the date of acquisition, and multiply by 30%, multiplied by 30%. So how much is that? That is 144. So point number C would be goodwill. Goodwill will be A minus B 6. This is how goodwill will be calculated, A minus B. Next thing I need to find out how much profit was earned by Sohan Limited, the associate, after the acquisition. On the date of acquisition, P&L account balance is 180. Okay. But if you look at the P&L account balance at the end of 31/3/2010, it is 200. Out of that, the opening balance is 180, and plus the proposed dividend is also given here 30. So my next step 2 should be profit earned by Sohan Limited, who is an associate, after acquisition, post acquisition profit. We can say post acquisition profit of Sohan Limited. In one earlier problem also we had done, we'll have to first write increase in P&L account balance, which is right now 200 in the balance sheet. You can see 200 here. I am going to circle it, 200, and now it was opening balance was 180 on the date of acquisition. Post acquisition increase in P&L account is 20. Point number 2, proposed dividend, because that is also debited from P&L account and credited to proposed dividend. So how much is proposed dividend? This 30. So my profit for the year is 50. And then the third working I will prepare will be carrying amount of investment. Carrying amount of investment in Sohan Limited as per AS 23. So my cost of acquisition is 150. I will add share in post acquisition profit, which will be 50 into 15%, 50 into 30%, that is 15, and the total carrying amount will be 165. And this 165 includes goodwill. I have to present that in the balance sheet. Is it right? So let us see how the balance sheet would look like. So in the balance sheet, you are going to increase the profit and loss account by 15. Parents profit and loss 15 increase, and investment will be shown at 165 instead of 150. Only two figures will change. The P&L account balance of the group will increase by 15 on the liability side, and the investment balance will increase by 15 on the asset side. And in investment you will have a disclosure about goodwill. So I will show you directly the balance sheet now printed in the book. Share capital will be same, sundry asset will be same, capital reserve will be same. This investment in Sohan asset side will be 2 will be 165 with a note includes goodwill 6. Here the P&L account will increase by 15 because the second effect of this 15 will go in the consolidated P&L account. Minority interest will not change, sundry liabilities will not change, parent company's proposed dividend 100 will appear, and the total is 2365. Have a look at the balance sheet. This way you will prepare balance sheet. Just write a note. Prepare balance sheet in Schedule 3 format. This is just for easy understanding, but in the exam, if the same question is asked, you are going to prepare balance sheet in vertical format as per Schedule 3. So that was a very important question number 12. Okay. Now we'll take another very important question. This is also very important question. Please mark. One reason is it is also in the study material. Other reason is it was asked in November 10 exam also. Okay. Ready? Bright Limited acquired 30% shares of East India Limited on 1/6/2009. See the date 1/6/9. It is not 1st April. And how much stake? 30%. Cost 2 lakh. By such an acquisition, Bright Limited can exercise significant influence over East India during the financial year ending 31st March 9. Financial year ending 31st March 9. So if you count the number of months, June, July, August, September, October, November, December, January, February, March. So total post acquisition period is 10 months. Post acquisition period is 10 months. Post acquisition period is 10 months, and that will affect my answer. Hence I am emphasizing on 10 months because all previous 12 questions, the shares were acquired at the start of the year. So you took entire 12 months. Current year was treated as post acquisition. Now the problem says during the financial year ending, this company earned a profit of 80,000. Now this 80,000 will have to divide into two parts. First 2 months, next 10 months. So profit of 10 months period will be 10 by 12 into 80,000. Is it 80,000? Yes, 10 by 12 into 80,000. This is the profit of, no, there is a small misinterpretation by me. I would like to rectify. This is the during the financial year ending 31st March 3, East India earned a profit of 80,000. This is not 31st March 9. It should be 31st March 10, and this is not here. 31st March 9 will be here. How can 31st March 9 be after 1st June 9? So during this year, the profit was 80,000 and a dividend was paid 50,000 on 12th August. Somewhere around here, 12th August 2009, dividend was paid rupees 50,000. Shares were acquired on 1/6. Dividend was paid for previous year on 20th August. Is it a dividend out of pre-acquisition profit or is it a dividend out of post-acquisition profit? So this dividend is related to year ending 31st March 2010. I'll read the whole line again. Very critical point. During the financial year ending 31st March 9, East India earned 80,000 rupees profit. This is the profit of the previous year, and declared a dividend of 50,000 on 12th August. Dividend was paid out of 80,000. This is a dividend out of pre-acquisition profit. What will be the share of Bright Limited in that? Bright Limited will receive 30% of 50,000, which is 15,000. So this is a dividend out of pre-acquisition profit. It will be reduced from investment, cost of investment. The cost of investment is 2 lakh minus dividend out of pre-acquisition profit 15,000. So remaining amount is your net cost of acquisition. This is, again I repeat for the third time in our current chapter, this is as per AS 13. AS 13 says dividend out of pre-acquisition profit should be reduced from the carrying amount of investment because it is treated as recovery of cost. Next line it says East India reported earning of rupees 3 lakh for the financial year ending 31st March 2010. Now this year from 31st March 9 to 31st March 10, the profit earned is 3 lakh, but our date of acquisition is 1st June. So I will take 3 lakh into 10 by 12 as the post acquisition profit, and this we will multiply by 30% to calculate the share in profit of associate after acquisition, and declare dividend of 60,000 on 12 June. The dividend was declared on 12 June. This will not be adjusted because I need to find out the balance on 31st March 2010. Okay, if I have to calculate the balance after the acquisition date, then we will deduct the dividend. Question is, compute the carrying amount of investment in separate financial statement of Bright Limited on 31st March 10. The answer is 1,85,000. We are going to deduct pre-acquisition dividend. Second question, consolidated balance sheet on 31st March 10. In consolidated balance sheet, I will start with 1,85,000, add share in profit. So you will take on your calculator share in profit for the period 1/6/2010 to 31st March 10. Total profit for the year is 3 lakh into 10 divided by 12 into 30%. So that is 75,000. So the answer for this part, 185 plus 75, how much is that? 2,60,000. Second answer is 2,60,000. And the third question is carrying amount on 31st March 10. So I will take 2,60,000, and this dividend 60,000 rupees into 30% will be deducted because dividend was received on 12 June and we are computing on 30th June. So 18,000 you are going to reduce from 2,60,000. So what is the balance now? 2,42,000. Oh my God. So now we are going to understand properly. I have explained. This is my first time explanation. Second time when we write the answer. So step 1 will be finding the carrying amount of investment on 31st March 10. Dear student, first you will write cost of acquisition. Cost of acquisition was 2 lakh. less pre-acquisition dividend. You have received dividend 50,000 into 30%. It is related to year ending 31st March 2010. 31st March 9, sorry. It is related to 31st March 9. Hence, it is a pre-acquisition dividend. You must reduce it 15,000. Therefore, carrying amount as per AS 13 on this date is to 1,85,000. This adjustment is as per accounting standard 13. You can mention. Now the next question is, so my starting number will become 185 for all further calculation. So when I am preparing consolidated financial statement, on 31st March 10, as per AS 13, I am applying equity method. So I will start with cost, that is 1,85,000 as adjusted for pre-acquisition dividend. So my cost after deducting pre-acquisition dividend, revised cost is 1,85,000, and I have acquired the share on 1st June 2009 and the year ending date is 31st March 2010. Therefore, I will take post acquisition profit for 10 months only. Date is also important. So my share will be 30% of 3 lakh into 10 by 12, hence 75,000, and my carrying amount on 31st March 2010 as per AS 23 will be 2,60,000, and then they have also asked you 30th June 2010 as per AS 23. So my carrying amount from previous working on 31st March 10, 2,60,000 minus dividend received 60,000 into 30%, 18,000. This adjustment we are doing as per AS 23. This adjustment we are doing as per AS 23. AS 23 says if you receive dividend, reduce the carrying amount because the associate net asset is reduced, and therefore now on 30th June 2010 the carrying amount of the investment as per AS 23 would be 2,42,000. Okay, and we'll write a note. In the absence of information, goodwill or capital reserve cannot be calculated because we are not given share capital of the associate. If you look at the problem, so you don't know what was the net asset on that date of acquisition, so goodwill or capital reserve cannot be computed. Now we'll come to question number 14. Again important question, considering this is an exam problem. Okay, study material, source, very important. We have already done similar problem. One more practice will not harm us. A Limited acquired 45% of B on 1/4/2000 X1. The price paid 15 lakh. Following are the extract of the balance sheet on 1/4/2001. So this will help me to calculate goodwill or capital reserve. 16 lakh was the net asset, into 45% if I do, that comes to 7,20,000, and my cost of acquisition is 15 lakh. So goodwill will arise 15 lakh minus 720, goodwill will arise 7 lakh 80,000. You paid 7 lakh 80,000 excess amount towards goodwill. Then it says B has reported net profit of 3 lakh. Add share in that and paid dividend of 1 lakh 10,000. Less share in dividend. Calculate the amount at which investment would be shown in the consolidated balance sheet. Very easy, already done. So you can just tick mark the answer in the book. First step 1, computation of goodwill. Cost of acquisition 15 lakh. Then we'll find out share in net asset of associate. Under that we have to write in the inner column associate share capital 10 lakh, associate securities premium 1 lakh, associate reserve 5 lakh, net asset of associate on date of acquisition will be 16 lakh, and 45% of net asset is 7 lakh 20,000. Therefore goodwill 7 lakh 80,000. Any query on this? We have already done so many times, you might have got bored also. Now next is calculation of carrying amount of investment. Cost of investment 15 lakh. I have made some changes in the presentation. Cost of investment 15 lakh. This you can write in the notebook. If you want a different presentation, institute presentation is printed in the book. Both are right. Cost of investment in associate 15 lakh. This is our way of doing and this is how it should be done also. Goodwill should not be written separately in the outer column. Goodwill should appear as a disclosure. So you have to write includes goodwill rupees 7 lakh 80,000, and to that I will add share in the post acquisition profit 3 lakh into 45%. Share in post acquisition profit 3 lakh into 45%, 1 lakh 35,000, and less dividend received. Instead of paid we can write received. 1 lakh into 45%, 1 lakh into 45%, 45,000. Therefore carrying amount of investment, take the total properly, 15 lakh 90,000. Carrying amount of investment 15 lakh 90,000. Carrying amount of investment 15 lakh 90,000. So that was the answer of this question. Now we'll come to question number 15. Question number 15. Source is study material. Again write down very important. Very important because this is a study material question. So we are going to understand. The answer is printed in the book. Later on you can check. I am going to explain the answer. The student will concentrate on understanding part. The answer is already there in the book. A Limited acquired 40% share in B on 1st April 2001 for rupees 10 lakh. So 10 lakh is cost. 1420x1 date of acquisition, 40% is the share. On that date B Limited had 1 lakh equity share of rupees 10 each. So that is share capital was 10 lakh. Share capital was 10 lakh. and accumulated profit of 2 lakh. So 10 lakh plus 2 lakh, net asset was 12 lakh. Net asset was 12 lakh. 10 lakh plus 2 lakh, net asset is 12 lakh. Agreed. During the year 2001-2, B suffered a loss of 10 lakh. First year loss 10 lakh. Second year loss 12 lakh 50,000. Third year loss 5 lakh. Show the extract of consolidated balance sheet of A on all the 4 dates recording the above events. So I have given the answer in the book, but I am going to explain. First thing what we need to do is calculate goodwill or capital reserve. Cost of acquisition, first line 10 lakh. Point B, less share in net assets on the date of acquisition. Let's share in net asset on the date of acquisition. So we have total share capital 10 lakh, profit 2 lakh 12 lakh. So you will take 12 lakh into 40%, that is 4 lakh 80,000. So the goodwill comes to 5 lakh 20,000. Goodwill comes to 5 lakh 20,000. So this is my goodwill. Now I'll come to year 1. Let us call it year 1, year 2 and year 3. In year 3 balance sheet, asset side, non-current asset, we will write investment in B Limited 10 lakh. Investment in B Limited 10 lakh includes goodwill 5 lakh 20,000. I repeat, includes goodwill rupees 5 lakh 20,000 and then less share in loss of associate. Share in loss of associate. Share in loss of associate. First year B Limited suffered a loss of 10 lakh. 10 lakh into 40%, 4 lakh. Therefore carrying amount would be 6 lakh. So the presentation in the first year balance sheet would be asset investment in B 10 lakh, includes goodwill 5 lakh 20,000, less share in loss of associate 4 lakh, and therefore carrying amount would be 6 lakh. Therefore carrying amount would be 6 lakh. In your institute answer, they have written goodwill separately in the outer column or in the inner column, and then they have taken the total 6 lakh. So either way you can present. Either way you can present. Year 2. Year 2 balance sheet, asset side, non-current asset, investment in B Limited, you start with 6 lakh, in bracket includes goodwill 5 lakh 20,000, includes goodwill 5 lakh 20,000, less share in loss of associate. share in loss of associate. Second year loss is 12,50,000. 12,50,000 into 40%. Oh my God. Now the loss is how much? 12,50,000 into 40%. That is 5 lakh. Huge loss. So carrying amount will now be 1 lakh. Carrying amount now will be 1 lakh. Carrying amount now will be 1 lakh. And then we'll prepare year 3 balance sheet. Year 3 consolidated balance sheet. Asset side, same thing you will write. Non-current asset you will write. Investment in B Limited 1 lakh, includes goodwill 5,20,000, less share in loss, less share in loss. Now the loss of the associate is 5 lakh into 40%, that is 2 lakh. Outer column will be nil. Outer column will be nil. Outer column will be nil. Okay. Why outer column will be nil? Because the amount of investment cannot be negative. The amount of investment cannot be negative, and therefore we will take 0 value. This is how you can present your answer in the exam, or you can follow the institute format also. It's okay. Both are okay, because finally I have to show 0 balance, and then there is a note at the end of the answer. You will write that note also. I will read the note from your book. Okay. The note says, if under the equity method investor's share of loss equals or exceeds the carrying amount of the investment, please follow the note. The investor ordinarily discontinues recognizing its share of further losses and the investment is reported at nil value. Additional losses are provided to the extent the investor has underlined incurred obligation. Investor has incurred obligation or made payment on behalf of associate to satisfy obligation of the associate that the investor has guaranteed or to which the investor is otherwise committed. If the associate subsequently reports profit, the investor resumes including its share of profit only after the share of profit equals the share of loss that have not been recognized. So this note we have done for the third or the fourth time. Next question number 16 is, describe the cases when AS23 does not allow use of equity method. This we have discussed. One is when the investment is acquired for disposal in near future, and second, when the associate comes under long-term restriction and it is not able to transfer funds to the parent. So that is the answer you have to write. This is a theory question. Tick mark for a 4-mark theory question. Question number 16. Already explained to you. And one last question. When is an investor required to discontinue the use of equity method? Already discussed. One, you don't have significant influence, and second, the associate comes under severe long-term restriction. The associate comes under severe long-term restriction. That time we will discontinue the use of equity method. Understood? So we have covered all the 17 questions in the classroom. Many questions we have taken from reference book for more practice and more conceptual clarity. If you have any doubt, you can message me on email vinod_ca@yahoo.com. You can send WhatsApp on 976692180. You can call on our number 9667671155. Okay, you can call on this number also. You can call on 9422365495. So many numbers are there. Call, message, get your doubt cleared. Okay, and I would request you, all 17 questions you must complete in the notebook. If you complete in the notebook, AS23 will be crystal clear for you for the purpose of examination. Thank you very much and wish you good reading, happy reading, and good luck for the exam.